So will Kevin Warsh's keynote speech at the annual Jackson Hole Symposium the Fed's holding this week reassure bond investors or add to their concerns, and what will it all mean for the stock market? Joining us now is Man Group Chief Market Strategist Kristina Hooper. Kristina, good to see you.
Great to see you, Mike.
So much to kind of try and boil down here. It felt as if today the bond market was a little better behaved. We're not really sure all the factors driving yields higher. Maybe this Treasury kind of measure is helping to break that. What does it tell you about the balance of risk and reward as it's developing?
So what I'm gathering from what we're seeing is that there are a number of different concerns that are being illustrated by the big rise in the yields since the start of the war, right? But those yields on the long end are not being driven by inflation expectations. Right. It's really about, I think, a lot to do with just fiscal unsustainability, because, of course, the war is going to cost us a lot of money, so that could be the catalyst. And also, of course, foreign investors' reticence to add to U.S. Treasury exposure and, in fact, perhaps want to reduce Treasury exposure. So I think they're looking at risks in a different way than, say, U.S. investors are when they look at the U.S. bond market.
In absolute terms, I guess you'd be tempted to say 4.7% on 10-year Treasuries in an economy growing 5-6% nominal. It's not necessarily unusual, historically speaking. The shape of the yield curve, not extraordinary in most ways. So is there any emergency to respond to in that respect in the near term, or is it just something we have to digest?
So I think the administration sees it as something to respond to, just given the announcement last week. But and I could see why they have decided to do that, because what we have is just competition for bond dollars. Right now we have all this AI debt issuance that's likely to grow. That seems to be the direction we're going in. And, of course, we have a growing budget deficit that makes U.S. Treasuries look less attractive, especially on the long end. So there are a lot of reasons to react. So, but unfortunately, reacting can sometimes underscore fears.
Sure. I kind of been pointing at the bond market is trying to, regulate access to new debt by companies and governments through repricing to higher yields. But does that, maybe restrain the other parts of the economy that aren't so well positioned, like housing? I guess that's a question we'll have to deal with. And then when it comes to Kevin Warsh at the end of this week, it's so tricky because he's wanted, at least in theory, to say, hey, let the market determine, what's relevant and exactly how policy ought to go. What signal is it sending?
Well, that's really the $64,000 question, because when you have bond market intervention by Treasury, then you're not getting an accurate read on what the market is telling you. So it's going to be very, very difficult for the Fed to rely on that. And so I think we're at a very difficult place right now, in that certainly Chair Warsh wants to remake the Fed and sees in many ways that it needs modernizing. But at the same time, and that includes less transparency, fewer FOMC meetings, it seems, based on the minutes. But at the same time, what we have is markets that have grown up on increasing transparency, on more communication, not less. And there's a real mystery around what exactly this new Fed will do. So I think we're hoping for a lot from this week's speech from Chair Warsh, but I'm not sure if we're going to get it, just because those committees don't seem to be ready to report final recommendations. So it might be something of a work in progress, and maybe a broader vision for what Chair Warsh anticipates in the future. But this is a difficult time for him.
What does it tell you, or what are the implications, I guess, on a practical level for portfolios, right? I'm guessing from everything you've said that you're not looking at 2.5% real yields in 10-year Treasuries, 3% real yields in 30s, and saying, hey, that's a good return. So I assume there are other things you might prefer to do.
So I think the key takeaway is that with yields going up, and I do anticipate yields on the long end continuing to go up, what we're likely to see is downward pressure exerted on equities, especially long-duration equities like technology. So this is likely to be a pretty difficult environment for tech, especially AI, just given concerns about whether or not the AI-related names, especially the hyperscalers, can get to a revenue level that justifies their spend. There was a recent article in the Journal about Camp Kotok and how the big buzz was around concerns that AI hyperscalers aren't going to be able to do that. And I think that is a key question. It's only amplified by higher rates. So from my perspective, it's about being well diversified, and that includes outside the U.S., where there's a lot less exposure to AI and that theme in general, especially in Europe, where defense spending seems to be helping drive the economy and could very well drive parts of the stock market.